Hello and welcome to a fresh new edition of Bazaar Morning Call. I'm Prashant Nair. With me, my colleagues Sonia and we have Mangalam here in our studios for the next 2.5 hours as well. Guys, hi. Good morning.
Good morning.
I mean, yesterday has been painful, right? I mean, the big headline number, of course, is the 4,600 crore net sell figure from FIIs. That hurts. I mean, that's a very large number. And in the face of it, by the way, I think it would be amiss to miss that DI has bought about, 2,500 crores worth of stock. So there was a little bit of balancing, but the selling figure just overwhelmed people on the other side. We've got some panicky comments coming in from not market participants or a bank CEO or it's from the Bank of England governor. You know, usually when you hear central bank governors say, the comment is that financial stability is topmost priority, etc., etc., etc. The comment from the Bank of England governor is there are serious risks to financial stability in the UK. I mean, that'll, I think, not be taken well. Overall, we'll talk about that. And I think for us here, we are once again in a bit of a wait and watch. This is like what we had last Thursday, or actually even on Friday morning when you had the jobs data later in the US, and which clarified things, but not in a good way. Markets sold off after that. We've got US CPI figures tomorrow. And I think that's the next big one before the November FOMC. So, there's a lot happening, but all of it kind of stops at that US CPI, beyond which we don't know. It depends on the data at this point in time. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Mangalam. Absolutely. I mean, it is sticky wicket, right, for global markets and for our own. And the Nifty yesterday fell below that crucial 200-day moving average of 16,980. So in that sense, it is psychological levels are being broken on the downside. As we were telling you, large selling by FIs, 4,600 crores, and put together now in the last 3 days, FIs have pulled out over 9,000 crores. So that's the kind of ferocity with which this market is selling off. Yesterday as well, the Nifty fell 300 points from the day's highs. Eventually, by the end of trade, the comment that came in from the UK government that spooked the markets in the last hour itself. We saw, that slide that took place post 3 o'clock itself. For our own markets, though, the US has not looked good, and that perhaps will take the trajectory forward today. The Nasdaq saw its 5th straight day of decline. It was down over 1%. The Fed meeting and the inflation numbers in the US, two key data points that one needs to watch out for. So we're going to chime with the global cues, at least for the next couple of days. The 17,000 level was also breached for the second straight time in the last fortnight. So give and take everything, I think bears sort of have a tighter grip on this market right now.
Look, it would seem that way. But, the question also is, are we getting at a bit of an extreme now? Globally, not here, because here markets are still outperforming despite, what we had yesterday. And that's the point, right? You have generally a sense in a few days of outperformance, and you wonder with amazement. I mean, the US fell 4%, and the next day reaction here was a 1/3% cut. But it showed up the next day, which is yesterday. So the global turmoil does seep through once in a while. It doesn't get us even in terms of the damage in the US compared to the damage here, but we fall less. So even as India outperforms, the damage is kind of seeping through. Yesterday, by the way, was a very large volume day. FII sold, as I said, 4,600 crores worth of stock, but broader markets also, if you just observe, the number of stocks going down on very large volumes was actually a pretty long list. Just a little bit in positioning. FIIs are net short 1.2 lakh contracts. At the lows of 15,200 in June, they were net short about 1.4, 1.45 lakh contracts. So this is not very far away. But so NSE discloses four data points in this. The client positioning is actually on the other side. What they described as client, this could be HNI, family offices. I mean, you typically describe this as smart money. Client long positioning is at 1.56 lakh contracts. This is near at an all-time high. So that is interesting. I mean, you got FIs net short, almost at June low levels. I mean, not quite at COVID. COVID was 1.8 lakh contracts short, and client positioning on the other side. So it's like a battle very clearly demarcated between locals and what the foreigners are doing. But the point is, to be fair, this could be hedging, etc. as well against other positions in the cash market. What could reverse this? Is FII short positioning at a bit of an extreme, which means there could be a reversal? I would think so. The only problem is you need a trigger, and the trigger perhaps could come from US markets. Nasdaq, for example, US markets have been falling non-stop, right, for the last many days. Nasdaq set a new 2022 low, and the next support for it is at about 98.38, which is the January 2020 high. And we get the CPI numbers tomorrow, and we get Fed speakers post the CPI numbers. Both are equally important, I mean, over Thursday and Friday, because one, they will be the market interpretation of whether the CPI is good or bad, and then you'll hear directly from Fed speakers who will decide on rates in terms of what they see, whether they need to moderate their, what they need to do in November to 50, they need to do more. So I think both are equally important. The question is, post-Thursday, could we get a bit of a change in the overall market texture in the US? It will entirely depend, like it did in the jobs data case, on the CPI number in the US. But it's possible. You got sort of, the things lining up in terms of positioning, etc., which is getting to a bit of an extreme from a foreigner's perspective. The only risk is a serious global shock to the system, and this is something that we are hearing more and more. People kind of throwing this in, saying this could be a risk. So, for example, I mean, the Bank of England governor saying that there are serious risks to financial stability in the UK. I mean, you don't hear that, generally speaking. What happened is the currency plunged. I mean, sterling, the pound plunged, and money rushed into dollar. Dollar was falling all day last night in the US. But as soon as you had this comment, the pound plunged and money rushed into what is perceived as a safe haven, which is the US dollar. So, these things, no one knows, no one can tell, and we'll be wiser in hindsight. On the Nifty, we are sitting exactly at the 200-day simple moving average, which is at 16,986. And I would say, and I said this yesterday, the September 30th low, which is about 200 points below where we are at 16,747, perhaps is an area to become a little more constructive in terms of taking long positions, etc. Mangalam, what do you have?
Well, a couple of data points, taking off from what you guys were talking about. I was just looking at the dollar index hovering near that 113.5 mark. We have the US yields, which are perilously close to that 4% mark, psychologically important mark. And when this happens, usually there is a fair amount of money taken off the table. And that's exactly what happened. 4,600 crore in the cash market. We know about that big headline number, but they sold lock, stock and barrel. 1,000 crores sold in index futures as well, and 1,600 crores sold in index options. What did they do? In index futures, they, net added 11,000 shorts, and as a result of which their longs are now just 15%. So 8.5 out of 10 FII positions are on the short side. Secondly, add to that, they've sold 95,000 calls. Between 17,000 and 17,200, 1 crore call contracts have been written. So that's telling you that, any sort of bounce may face a fair amount of congestion until that bounce sustains. Because if that bounce sustains, then all these guys will have to run for cover. Is there a case for a bounce? Well, we don't know yet. But if there is, this is the point. Why? Because the put-call ratio is at 0.7. Usually when it comes closer to 0.7 mark, we do see a bit of a bounce. Secondly, the Nifty 200-day moving average is as close to, yesterday's close. And we are very close to the recent low of 16,747 as well. Importantly, the Nifty has bounced back from the 200-day moving average twice in the last 15 days or so. So can we get third time lucky? The data to track then would be what happens globally. We have the India CPI today as well, but I don't think that will be watched as much by Indians as the US CPI tomorrow, Fed minutes today, and the US Producers Price Index today as well. And if there is a bounce, who benefits? Not the FIIs, not the DIIs. It is the retail investors, HNI investors who benefit. Why? Because the FIIs are long just 15%, DIIs are long just 29%. The retail or the client positioning is at, like Prashant said, 1.5 lakh. At the highest, they are 69% long. So all the shorts of the institutions are actually being absorbed by the clients and retailers. If the market does bounce back from here, they stand to gain the most. If it doesn't, then they stand to lose the most.
Okay, it's interesting how the markers for our market have moved lower, right? First, it was the 17,000 level. Then it was the 200-day moving average. And now we're all watching out for the recent low, which is 16,740. Well, I just wanted to also point out that Morgan Stanley put out a very interesting note on that subject of how many more rate hikes and how much will it impact global markets. They said that persistent rent inflation should keep core CPI uncomfortably high, and this will leave the FOMC on track for a 75 basis points rate hike in November. Expect the core CPI to come in at 6.6% year-on-year for the US. So pretty elevated as far as the inflation numbers are concerned. And a 75 basis points rate hike is being priced in. by Morgan Stanley in the month of November. So we're not done yet, of course, with this rate tightening cycle. And you can see it across the board, not just in the US markets. But let's
just one more thing. IT services has been a big talking point, right? I mean, we got a big bounce. The index is still about 4% off the recent lows, just 4-5 days back. But yesterday, the IT Nifty IT index reversed. There is some more sobering news which has come in. So yesterday, I was reading the Wall Street Journal saying that PC shipments, personal computer shipments, have plunged to plunged the most in a long time. They're down 20%. It's the steepest drop in more than 20 years. And this morning, Bloomberg is reporting that Intel is planning to, on the back of, lower PC shipments, planning to lay off thousands of employees. They'll report numbers next week. So this, constant stream of bad news, right? In terms of just we got the IMF forecasts yesterday, and that sort of shows us in pretty good light for 2023, although in 2022, the biggest downgrades are for India and the US. Our growth has been shaved off by them by about 0.6%. These are their forecasts. But 23, there's absolutely no change. This will keep coming. And I think a lot of people will be wondering what to do with IT services, because that still remains, to my mind, one large block, a large grouping of stocks which has taken the biggest damage and remains completely bombed out, notwithstanding the recent bounces we've seen. But one will have to be very, very selective here and maybe kind of play trading bounces for what they are and not really go headlong at this point in time.
In that context, what stayed with me from TCS's commentary was they said that the macro environment we can't predict, right? There's no visibility. For our own company, what we're doing right now is focusing on cost efficiencies, cost cutting, and just managing the ship well, right? When large companies say that, it is indicative that there is a big slowdown and you're just trying to sort of hold forth.
And the slowdown is in the middle of the consumer pack, because like you said, where PC shipments are down, but what is actually up are the shipments for Apple. Apple's actually grown 40% when overall shipments are down by 15-odd%. And in Apple as well, when they said that the iPhones are not being sold, it is just the middle of the pack. It's the 14 Plus Pro, which is selling more than what they anticipated. So the rich guys buying lock, stock and barrel, the middle guys, there is a bit of a
Who are these guys buying the 14 Plus Pro?
We've got somebody sitting right in between.
No, I haven't bought a 14 Plus Pro. The last phone that I had was 11. But Sonia for sure, maybe.
We're all Apple lovers, guys. Let's not deny that, okay? All right, let's move on and kickstart the show. On the equities front, we have a comment first up coming in from Amish Shah of Bank of America Securities, who says, in the near term, higher crude and slowing global growth along with depreciating currency could create a downward spiral of macro risks. They see a 40 basis points upside risk to their FY23 budgeted fiscal deficit estimate of 6.4%, and they see the current account deficit at 3% of GDP versus 2.5% threshold, driven by uncomfortably high trade deficit. Thus, if crude and currency risks play out, they could deteriorate India's macros, and they see risks to the capex upcycle thesis. Given this, they believe further earnings cuts cannot be ruled out. They cut their Nifty trading range to 16,500 to 18,500, and they lowered the base target to 17,500.
Let's get you some money market news as well. We have Kunal Sudani of Shinhan Bank saying that US inflation expectations, upbeat comments from Fed policymakers, and rising bond yields have kept the dollar bulls hopeful ahead of Fed minutes. Fears of global economic slowdown will add further strength to the dollar index's demand. And cooling off Brent prices as well as other impact on demand may provide some respite to the rupee. For the USD INR, 82 acts as an important support, while 82.65 is a bit of a resistance.
Okay, let's get you some bond market views then. Neeraj Gambhir of Axis Bank says the market witnessed losses this week on a global bond rout and fears that the RBI may take some action to check the falling rupee. For the coming week, the market will take cues from inflation data, FOMC minutes and the quantum of SDL borrowing. For the week, the 10-year is expected to trade in a range of 7.35 to 7.50%. All right, let's kickstart the show. We have plenty of stock-specific action to track today. So without wasting any time, we'll get to it in our special Top 10 segment. Here are the stocks that we're looking at. Delta Corp, there's Genesis International, Suzlon, Gujarat Pipavav, L&T Finance, Indus